Welcome everybody to another episode on Debits and Credits with Haas and Dawe. And today we're going to stay inside your operation and analyze your expenses as an escrow or title company. And so how are there ways to save money? How are there ways to increase profit margin? How are there ways to share the wealth, so to speak, within the company where it doesn't create too much of a burden from an operation standpoint? As a small business owner, you want to be in the habit of reviewing your spending in relation to revenue being earned to ensure profitability and healthy financial statements and financial status. What's interesting is in trying to establish this model of revenue recognition, revenue review, and looking at expenses, you want to look at percentages of revenue for reasonableness. What makes sense relative to how much you're spending on particular expense items relative to the amount of revenue coming in. Because in escrow and in title, it's different than, let's say, in what we do as an accounting firm or what attorneys do, architects, and so on, where we charge on a per hour basis based on our knowledge and the information we're sending out, and on the work that we're doing, provide you with quality information relative, whether it be an audit report, a financial statement, a tax return, and so on, or consulting. You have what's called an escrow fee or a title premium, and it's based on usually a percentage of the cost of the property, of the sales price. And it could be anything from a base amount and so much per thousand of the sales price. It could be based on just on so much per thousand. If it's a refinance, you could have a model of a flat rate of, depending on the amount of the refinance, as to if it's, let's say, below $1 million, a certain fee is being charged. If it's above $1 million, another fee is being charged. On commercial property, it could be based on, again, so much per thousand on the amount of the sales price of the property. And so at that point, you're looking at how much or how many escrows you need to close in a particular month, as we say, to be able to keep the lights on, to pay for rent, to pay the utilities, to pay certain direct costs and compensation and so on. And so these are things to think about when you look at I call it the pie, and how to divide the pie up between what you need for certain expenses to cover the dollar of revenue that's coming in from the closing of an escrow. So what are the big ticket items and how much you should be spending on each, and in what realm and what range? The biggest expense you have is compensation, employees' expenses. These are salaries and wages. This is commissions, payroll taxes, employee health insurance, possibly a retirement plan contribution, other employee benefits. Now, in looking at compensation, there can be certain people who are paid on an hourly basis. So there are certain people who are paid on the same amount every month, which is commonly referred to as a salary basis, which is taken with a grain of salt, because just because someone is on a salary doesn't mean they're treated any different than someone who's treated hourly in many ways regard to California employment law. But you have these compensation costs going out, and then you have people who as whether they're escrow officers or escrow assistants, there may be arrangement that they receive a commission or a bonus based on the productivity of their unit. And so that's part of the compensation cost. And the timing of when that compensation when the bonus or the commission is paid. Is it paid at the same month of closing? Is it paid the month following closing? Is it paid on a quarterly basis? These are all different ways that affect compensation. And then you have, as an employer, you have payroll tax expense. And as an employer, for every dollar that goes into the Social Security fund for an employee, the employer has to match it. Every dollar that goes into Medicare benefits that comes out of the employee's paycheck, the employer has to match as well. And then there's also state unemployment insurance and federal unemployment that an employer has to pay into. So if you figure on a I guess an estimate basis, anywhere from to 9 to 10% of whatever you're paying in compensation is going to be paid in employer tax, payroll taxes. That's probably a fair estimate. And then you have health insurance. As we all know, health insurance goes up every year. And there are different ways to look into how you want health insurance to be paid. Some companies are pay 100% of the premium for the employee. Some companies will even pay 100% of the employee and dependents care. But normally it's of the employee. Some company will pay a percentage of the premium and share that with the employee. Depends on the size of the operation, the expense of the health insurance premiums, so that gets to be a very big ticket item these days. And then there's retirement plans, and some companies may have something called a simple IRA. They call it simple because there's not a lot of governmental reporting on it, where employees are able to take a percentage of their payroll of their wages and defer it into an IRA, and then the employer has the option based on how well the company is doing of matching that contribution up to 3% of an employee's compensation. Now, there's also 401k plans where there's allowed a larger amount of employee deferral of salary or of wages into this retirement plan. And again, the employer has the option to have a match to that employee contribution. Or there may also be an employer may have their own profit sharing plan, or again, they put in a percentage of the employee's compensation. And so between payroll, tax expense, and medical insurance, the employer also has to pay workers' comp. California is a workers' comp mandatory state, so all employees are mandatorily covered for workers' compensation insurance, which the employer has to pay. Now owners of companies like shareholders or sole proprietors or members of partnerships or LLCs can waive out of being covered by workers' comp, but otherwise all employees have to be covered for workers' compensation. And normally workers' compensation, the premium these days, it's based on compensation amount, so it's usually for every $100 of payroll paid out, it's in the 50 to 60 cents range, 50 to 60 cents for $100 of compensation for an escrow company or a title company. When you get into other areas like construction and contractors where there's more heavy-duty labor involved, then the rates for workers' compensation insurance are higher. So a lot of these employee benefits can be anywhere, on average, 45 to 55% of revenue. It's very common to be in that range these days. And depending on if there's any other benefits that are being offered, let's say you bring in lunch on once a week for the company, or there's quarterly activities for the company, then this could add to the cost of the employee benefits from the 45% to the 55% range. Occupancy, which is rent on the office space, that's your next biggest expense, and that could be including rent and utilities and any other type of costs that the landlord or operationally are required to keep the lights on. And that could be anywhere from 10 to 15%. You really would try to keep it no more than 10%. But again, depending on where rents are these days and with the way the economy is, it could creep to a little bit more than 10%. Then we're looking at other areas which are becoming very, very common today. We talked about artificial intelligence and it's your information technology, what they call IT, your IT costs, and whether it be the software that runs that you have for your escrow operation, or whether it be software you have for your accounting system, whether it be software you have for protection of your overall operations that your IT people put in place, protect against ransomware and malware and so on. All these things we think should be around 3% of your revenue. Then you have legal, accounting, other compliance expenses, anywhere from 5 to 7%. And that would include compliance. When we talk about compliance, we're talking about the Department of Financial Protection and Innovation, the Department of Real Estate, the Department of Insurance, costs that you have to pay them on an annual basis. As all the independent escrow companies now know, the annual assessment has gone up from $2,800 to $7,215 per year for the DFPI annual license assessment. And the billing rate for the DFPI on their regulatory exam has gone up from $95 to $120 per hour. And so the cost of compliance is now become a little bit higher. Now, if you take the $7,215 of the DFPI costs, and then you take what you pay to Escrow Agents Fidelity Corporation for those two assessments a year, and then you divide that by 12, it's probably going to be about $800, $700 to $800 per month is what you need to budget for that. And so that's could be the cost of a refinance. So if you look at again your budgeting in these types of ways of what do these factors cost you, and your annual audit that we charge to do for, how much does that cost you on a monthly basis? And a lot of these expenses can be broken down to monthly. I mean, obviously your rent you pay monthly and utilities pay monthly, but you can work out with us with our rates that we charge. We're more than happy to take the annual audit cost or all the fees we do for you over the course of the year and divide it by 12. So you have a monthly net that you know what you're going to pay every month for us. And so you can do that with some of your other customers or your vendors as well. Now, advertising and promotion, we think no more than 5%. And that then if you're dealing with a sales rep, part of that has to be taken into consideration of, in addition to their compensation, what's going on relative to how much is being spent for advertising and marketing and promotion. We think try to keep it around 5%. What should profit look like? In a perfect world, we would like it to be as 33%. That's the old days, and that's before compensation was higher. That's before the cost of how long it takes to do an escrow. Look, when I started, you could get 100 escrow files in a single file cabinet drawer. Not anymore. It's probably 25 if you're lucky. And for those who are paperless, you know that what I'm talking about as far as the amount of paper. Because if you were to print out one of your paperless files, I mean, it could be 300 pages, 350 pages easily, with all that's going on. And so, what's the profit margin? Now, profit is defined as being the net profit after taxes divided by revenue. So let's say you make $1 million in fees for a year, and you have $900,000 in expense. So your net profit is $100,000. So you take the 100,000 divided by $1 million, and so your profit margin is 10%. So after taxes and all costs, we think in today's world a healthy benchmark to shoot for is 15 to 20%. 15 to 20% profit margin. But this is also before anything's identified for management bonuses, whether it be additional commission to managers or whether it be bonuses to ownership. We think at that point 15 to 20% is healthy before you make those additional expenditures. And so it's something to keep track of. What do you want your return on investment to be, so to speak? So if you know what your capital is you've invested in the company, and maybe it was 100,000 to use a round number, you want a 10% return on that investment every year. Do you want a 20% return on investment? And then as retained earnings accumulate, then keeping in mind that let's say you say, well, I want 12% return on my investment. Every year that 12% is going to be a little bit more because you're going to continue to add reserves to what you already have in place for capital and retained earnings. Identify the direct costs to help you calculate your monthly net. Direct costs include rent, include utilities, include your software vendor, include, let's say you have your attorney on retainer, or let's say you're paying us on a monthly basis. You have certain other rental payments to make, let's say for a copy machine or for an automobile. All these things that represent direct costs, are going to be the same every month, whether you close an escrow or not. And so that's what you want to know, that helps you again to get to what does your monthly net need to be. How many escrows or title orders do you need to close per month to stay in business? And that's something to help identify what's your realistic venture for what you want to do, coming up with profit margin, what's available. And if you're a situation where you are an LLC, no taxes are being paid at the LLC level. Everything is being taxed by the individual. If you're an S corporation, there's a little bit of tax to pay to California. It's an $800 minimum. It's 1.5% of your taxable income, but no less than $800. And so take that into consideration a little bit. If you're a C corporation, a non-F corporation, the tax is paid by the corporation. And so you have a situation where the federal tax rate is 21% flat on all income and 8.84% flat to California. So if you figure 29% is your tax rate, it's a question is how much money to leave in the corporation, how much profit to leave in the corporation, and pay some tax at the corporate level, as opposed to what the question is zeroing it out. Now we recommend that on the one hand, you don't want to not pay any, you don't want to just let the corporation pay an abundant amount of tax if it can be avoided. And so you want to think about doing some tax maneuvering. But also you don't want to necessarily just go in every year and think, I want to zero out the corporation and not build up for reserves. The tax rate for corporations and for individuals are pretty close to the same these days. Some individuals will be higher than 21% and creep into a 25 or 28% bracket. But for the most part, it's about the same. So you want to be careful about not just, on the one hand, not just leaving the money in the corporation or it's going to go unused, but also not just taking out money for the sake of taking it out and not allowing the tax burden to be borne, a small tax burden to be borne by the corporation. And at the end of the day, it will help you come up with what you want your profit margin to be, what's realistic, what can help you grow the business as you allow for reserves. Let's keep in mind, as we've talked about in a prior podcast session, we think the real estate cycle is 7 to 9 years. And after that cycle, it's going to get quiet. Not for a long time, but it's going to get quiet, and you want to make sure you have reserves. So it's a recommendation that you allow the cash to build up in your company. Take some out, of course. It's for bonus and so on. But allow the cash to build up in your company. Keep a healthy profit margin and allow your reserves to expand. So that's today's episode from Haas and Dawe. We'll see you next time for the next telling of a tale.